When Rivian decided to go public, it was valued at $66.5 billion, which allowed them to raise $12 billion of capital. Since their IPO, the share price has skyrocketed from $78 to an all-time high of $172 within 1 week. At its height, that gave Rivian a valuation of $146 billion. The market clearly believed that this electric vehicle company, which did not generate any revenue, is worth more than General Motors, which delivered 6.8 million vehicles in 2020. Welcome to Way to Wealth Investments. In this video, we're going to explore whether Rivian's valuation is justified. We will discuss whether it has the ability to be the next Tesla, as many investors clearly believe. Let's start with the positives of why Rivian is positioned well for success. According to McKinsey, the largest automotive markets in the EU, US and China will be fully electric by 2035. Demand for electric vehicles is fast outpacing supply, which places Rivian in a sweet spot. There is a shift in demand for trucks and SUVs, which are the most profitable segments of the automotive industry. Tesla is recognized to be the current leader in the EV sector. However, there are advantages of not being first to market. For example, you can learn from the mistakes of your predecessors. This is evident in Rivian's strategic decision to raise a large lump sum of cash in its IPO. This allows them to secure their future. When Tesla went public in 2010, it was valued at just $2 billion and managed to raise a measly $226 million. According to Elon Musk, Tesla was only 1 month away from bankruptcy during the ramp-up of their Model 3. It is clear that many investors are seeking the next Tesla in EV competitors, such as Rivian and Lucid Motors. To understand why investors are willing to pay a premium for Rivian, we need to look at the returns on investment that Tesla has generated since its IPO. If you bought Tesla shares in 2010, you would have 300x your money. Let's say you invested $1,000 back in 2010, you would have around $300,000 today. Whilst the idea to find the next Tesla sounds great, let's never forget what happened to Nikola. To many people, Rivian is a company that surfaced overnight, but that could not be further away from the truth. The company was founded in 2009 by a guy called R.J. Scaringe, an MIT mechanical engineer. In 2015, Rivian decided they wanted to introduce their trucks to the everyday consumer. They also announced their delivery vans for commercial purposes. The big names behind Rivian is another reason why investors are flocking to this stock. Prior to the IPO, Amazon invested $1.3 billion and Ford invested $820 million. I will not be surprised to see Ford, a direct competitor, selling their stakes soon, once any lockup period expires. At the height of Rivian's valuation, Amazon's investment was worth $21 billion. As well as being an investor, Amazon is also a customer to Rivian. They've placed an order for 100,000 last-mile commercial delivery vans to be delivered by 2030. In the S1 filings with the SEC, Rivian stated that the deal with Amazon may be terminated by either party with or without cause, subject to compliance with certain termination provisions. Basically, the contract with Amazon is not concrete. Now let's delve into the valuation and figure out if these numbers actually add up. Rivian introduced two types of trucks, R1T and R1S. The company started making deliveries of the R1T in September 2021. R1S deliveries will start in December 2021. The company expects to fill a backlog of 55,400 vehicles by the end of 2023. The CEO has publicly stated that they are looking to ramp up their production to at least 1 million vehicles by 2030. In 2020, Tesla was only able to produce 500,000 cars, and they've been producing cars for 18 years. Rivian currently has one facility in Illinois, which can produce 150,000 cars per year. They are planning to expand the factory to produce 200,000 cars per year. That means they will need at least 4 more factories of similar size to achieve their target for 2030. As you can imagine, building new car factories is not cheap. In its S1 filings with the SEC, Rivian said it expects to spend another $8 billion of capex by the end of 2023. The company also warned investors that it will likely continue to incur operating and net losses in the near future while it grows. Remember that $12 billion they raised in the IPO? You can expect that to deplete within the next 3 to 4 years. I am of the opinion that Rivian will need to raise more capital by 2025. According to the company's website, the starting price for a R1S truck is $70,000. So this is what I'm going to be using as an average for their vehicle in my valuation. Bear in mind that Ford F-150 and Tesla Cybertruck are expected to be priced at under $40,000. Based on an average of $70,000 and production of 1 million vehicles, Rivian is staring down a revenue of $70 billion by 2030. For the sake of comparison, Tesla's revenue was $32 billion in 2021, and they've been producing cars for 18 years. I am assuming that Rivian can achieve a 6% net profit margin by 2030. I understand why some investors might want to value Rivian like a tech company, but my valuation here is with the assumption of an automotive company. The reason why I am not valuing Rivian like a tech company is very simple. The S1 filing suggests that 90% of Rivian's revenue will come from selling cars. Even Tesla has a net profit of 6%, which is the average in the automotive industry. Tech companies generally have 30% plus in net profit, which I do not believe Rivian or Tesla can achieve. My price target for Rivian in 2030 is $63, which means about 75% decline from its all-time high of $172. This was with my most bullish case, with no assumption that the company will increase shares outstanding. Don't forget that I did mention earlier on that I think Rivian will be back on the stock market to raise more capital. This is the reason why I am not interested in buying Rivian stock anytime soon. Perhaps if the stock price was to fall about 90%, it might entice me. If you think this is not possible, just take a look at Amazon stock in 1999 when it fell from $105 to $6 by 2001. Whilst it is nice to get an endorsement from Uncle Jeff, what will be nicer is an opportunity for retail investors to partake in the stock market without a hefty valuation. Thank you very much for listening. Until next time, my friends, stay curious and be happy.